Oh, so welcome, guys. Apparently, we've been here live for a minute. For those of you who don't know me, I'm Nathaniel, NLW. I host The Breakdown, which is a daily podcast on macro, on Bitcoin, on the shifts of power in the world and what they mean. And so, my interpretation of this session title, kind of these macro investors sound off or something like that, is that what I want to do with it, I guess, is basically let's have this kind of conversation about how the macro environment, how everything happening in the world is finding its way into markets, be they crypto markets or traditional markets. And so I guess maybe as a way to kick that off, what have been your feelings? And maybe let's start with Ari, and then we can go to anyone else on watching first how the market has shrugged off COVID-19, and then second, how it has responded or not responded to these protests, this new kind of huge batch of civil unrest.
Yeah, so the markets are very explicitly reacting to Fed stimulus, which they're kind of assuming is infinite. So talking to like some of the biggest buy side investors, the disconnect that we all see, rising unemployment and yet a market marching higher. It's not complicated. It's you have a Federal Reserve that has a massive amount of money to buy corporate bond ETFs that basically says they'll buy equity if they need to. That infinite, and we have a generation of investors who've been taught not to fight the Fed. For basically 20 years, you've been trained. Really, the way to invest is just figure out where the Fed's going to push money. Eventually that breaks, but these things can take a really long time to break. Personally, I'm skeptical that it's going to last much longer, but wouldn't shock me if we made new equity highs over the next 6 months before a collapse. And the thing that breaks it, whenever you have kind of a central bank driving asset prices higher, is that can continue as long as faith in the central bank continues, which can be a really long time. Basically making a bet that will end is a bet that kind of the central banking backbone will itself crumble, which is a generational event, or far more rare than once a generation. So I do think we're headed for that personally. But that's why, a lot of investors, they would say that's almost never a good bet to make. You're almost always betting the Fed can keep pushing things up if they have the political will to do so. So that doesn't surprise me. And then on protests, historically, I've been trying to catch up with my economic history and looking at market reactions to protests at different countries, different time periods. You can almost never locate riots on a chart. If you're looking at equity in almost any country, you can almost never find the riots. And I don't have like a really simple answers for why that is, except that they don't tend to have immediate, massive impact on corporate earnings. At the end of the day, markets do not reflect the economy. They reflect a handful of stocks, a basket of stocks. With the S&P 500 marching higher, it's basically 5 stocks going up and everything else going down. So yeah, the U.S. economy is I was going to use profanity, is doing very badly. But the earnings of a small number of giant companies have been doing reasonably well, companies like Amazon and Microsoft. And so when investors look at the recent protests and riots, is that going to impact Amazon's bottom line or Microsoft's? Maybe, right? But then we need to think about how much worse these things can get.
I like to look at data, and obviously we all like to look at data. And so let's go from the top. So CNBC this afternoon, after the close at 4 o'clock, posted stocks jump as Wall Street focused on the economy reopening. S&P 500 now up 40% from March lows. What has happened in that time frame? So we've had 1.8 million confirmed cases in the United States, 414,000 have recovered, over 107,000 deaths. We've had a global pandemic. We have been sheltered in place. That is why we're all on video and not together in person right now. What else has happened? We have had over 40 million jobless claims in the last 10 weeks and another 2.1 million filed for benefits last week alone. So we've had this structural issue happen where all of a sudden this global pandemic has caused 40 million unemployed. We are now seeing things breaking down among society. And then on top of that, we've added a massive social unrest issue. And so I think my colleague actually wrote it really well, Jeff Dorman. The system is broken. We've had the scariest pandemic in the last 100 years. It's below what he calls a fourth quarter lead. If you were using a football analogy, it's blown a fourth quarter lead, leading to racism and social injustice, which is then playing the second game of a doubleheader following a match between record unemployment and decades of wealth inequality. There's no fix to any of this right now. And so, for all of us that are, obviously focused on digital assets, this is a cornerstone time for us because the system is breaking. We don't want things to break, but the system is breaking because it is structurally unsound. And so when it is structurally unsound, you better have a place to go, to move from that. And digital assets, Bitcoin and other digital assets, in my opinion, and the opinion of others, is an untethered asset. And so that is why it is an important moment in time, because the system is structurally unsound and it is breaking. And the trust system that we have is breaking and is broken.
Spencer, what do you think?
Guys, I'm not sure if this is where I parked my car.
Excuse me, this is a Wendy's.
I'm not a macro tourist here. No, but in all seriousness, I'm deeply interested in macro topics here. I want to note that I'm in no way an expert. I am absolutely a tourist. I do crypto venture capital, and certainly watch in the way that some of these things are tying back in. Careful about extrapolating too far here. Certainly I think the biggest event here shouldn't say the biggest event because there are several larger events happening, including the current demonstrations as well as the pandemic. But the most relatable to our industry would just be the monetary response, right? So we don't even have to theorize about the amount of fiscal or monetary stimulus that we've seen so far in terms of will it be good, will it be bad, what are the implications going to be? There are a lot of reasonable hypotheses on a number of different frameworks there. I think that what's undeniable is that we are in uncharted territory, and that involves some element of increased risk. And I think that there's an increased desire and appetite to hedge some of that risk. And I think that Bitcoin and crypto assets broadly are one of the vehicles that people can use to help hedge some of that risk.
It's interesting. So I want to come back to the Bitcoin point that I think you're kind of making, Spencer. But first, just going back to something that David said, this idea of the system being broken is an interesting one, because something I've seen, an interesting analysis that I've seen from people like Ben Hunt, are that actually the system is doing exactly what it's designed to do. It's just that if you haven't been kind of exposed to and sticking your head directly in the mouth of what that looks like, right? The fact that these markets are relatively disconnected from the real economy, that they do care mostly about what Fed policy is going to do in terms of the cost of money, then it becomes jarring to see economic pain at the same time as, something that is effectively an asset price increase machine and or a political scorecard or utility just kind of laid so bare in front of you. And if that's the context, I think that part of what that contributes to is a narrative rupture that creates openness for something else. And so I guess my next question to you guys is, to put it bluntly, has there ever been a more significant narrative moment for Bitcoin specifically? I mean, digital assets more broadly, but I certainly, probably by the way that I'm asking the question, you can guess my answer, but I'll let whoever wants to jump in first on that one. Or maybe let's actually go back to Spencer, because I think this is kind of the point that you were starting to make.
Yeah, sure. I'll jump in. I agree with the leading question that, I think in the last financial crisis of 2008, I was a very young trader and investor and thought, man, that's it. This is the end of the modern, fiat-based monetary system. We've laid bare the lie that Wall Street and the Treasury Department and the central bank kind of serve the country, and it's very clearly a Wall Street bailout. These long regimes tend to last a lot longer than you think, and what ends up happening is people give up on betting against it. So you had a generation of investors and traders that basically tried to short the dollar after 2008, that tried to bet that interest rates were to rise, that we'd get inflation. You had people looking at massive money printing in 2009, 10, 11, 12, and basically those people got washed out. People running hedge funds making those bets went out of business, and when the end finally comes, it usually looks weirdly inevitable in retrospect. So think about the 2008 crisis again. We knew real estate was in a bubble. We knew it was going to crash. Everyone in that market knew it was a bubble that was going to crash. And yet it still crashes out of the blue and violently. And those people still lose their money. Well, how do they lose their money? Because I forget which, I think it was the Citibank CEO at the time said something like, when the music's playing, you have to dance. That's a real reality in markets and investing, in that you can't be a decade early. You can't even be 3 years early on these calls. And so what ends up happening is we all see the end coming, and the warning signs become louder and louder and louder. And then it still is a really sharp crisis because people have been so thoroughly trained to buy every dip. They've been so thoroughly trained to just ignore the warning signs because the warning signs have been there for a long time. So yeah, I think what's happening now is, unprecedented gets used. The word unprecedented gets used a lot, but 10 years ago, 20 years ago, it was unfathomable to have a president tweeting against central bank autonomy. It was unfathomable to have a head of the Federal Reserve saying we have an infinite money supply and can print at will with no problem. It was unfathomable to have Congress talk about proposing legislation to print $1 trillion platinum coins. Those are all truly mind-boggling, crazy things, and we just become jaded to them because if Congress talking about the platinum coin didn't cause the dollar to collapse, what will? But I personally am betting and think that the end of that system is coming, that the lie's been laid bare, but it's still not an overnight change. I don't know exactly how this is going to play out. You think about the real estate crisis. The stock market crashed kind of all of a sudden in latest 2008, but real estate had been crashing for a full year. CDOs have been crashing for a year. When I was a trader at Susquehanna International Group, I was a young trader, and one of the partners of the firm in mid-2017 ran across, he was like jogging across the trading floor, and someone said, I won't name him, but someone said, what's wrong? And he said, the markets are crashing in slow motion. And Susquehanna was a giant market-making firm that had their hands in kind of every liquid market, and the U.S. equities continued to make a new high into mid-2018, and yet things were collapsing, like even as that was happening, and not just in the abstract, markets were collapsing, just not markets that day traders look at. It was things like the muni bond market was frozen, and if you even looked at Bloomberg, you didn't see it because what happened was the trading just stopped. Liquidity vanished. The bid-ask spreads became crazy. The prices didn't fall because no one wanted to sell their muni bonds at a 10% discount. They all thought, they were all hoping, no one wanted to be the one to actually have to mark to a new market. So prices kind of just sat there for a year, totally illiquid. Everyone, all the insiders knew they were broke. Like they knew, I won't mention a firm, but people who had billions of dollars in muni bonds knew that they had lost 20% of their value, but they were still marking them at the old prices because nothing was trading. So I think we're in a very similar dynamic, but with the monetary system as a whole. So with that to say, that's incredibly bullish for Bitcoin on a medium-term horizon, medium-term meaning a few years, possibly quite much sooner. But I say all that in that, I get asked a lot, Ari, Bitcoin isn't up a lot. Obviously it is now since Black Thursday, but around Black Thursday, I would get asked by traditional media, Ari, isn't this the scenario Bitcoin was built for? Are you worried that Bitcoin's not up? And I would give this kind of an explanation as to why I wasn't worried. I know that this takes longer to play out than you think. And what seems like it should happen in a month might take 3 years.
Well, I get asked a lot about that too, by the way.
Go for it.
I get asked about that specific point too, about Black Thursday. And, a lot of people were like, well, to Ari's point, why didn't Bitcoin perform, relative to what you all have been saying? It is untethered. It is, it is something that's uncorrelated, if you will. And as we know, obviously, when, the VIX went up as high as it went to in the 80s, effectively, correlation all goes to 1. So everything effectively tumbled at the same time. And so what happened in that specific case, and I think a lot of people still don't understand this from the outside. Remember, we are all in this world where we understand digital assets, where we understand, blockchains, where we understand these projects. There is a massive world out there that still does not understand this. And that was obviously represented by what happened with Goldman Sachs a few days ago, because they still don't get it. And so, there is this massive play out there. And effectively, we're in a place right now where the information asymmetries are still very vast. And so it is still, mind-blowing to me that people are asking me about why Bitcoin went to the way it was. It's because you saw every single person, every hedge fund manager, all the managers out there that were getting margin called, effectively having to sell any liquid assets they could to cover their margin. And so that was the reason why. It wasn't because Bitcoin all of a sudden crapped, and it wasn't because all of a sudden every person out there in the world believed that Bitcoin was false. It was because, holders of it needed to cover margin. And so it's actually really interesting, as I posted, CNBC, talked about the S&P rebound of 40%. If you look at the, Black Thursday, kind of recovery to now, Bitcoin has recovered 160%. And so, again, that is something that a lot of people aren't talking about because, again, there's this information asymmetry problem.
Yeah, I think one of the things that is interesting is the disconnect between what timescale people are talking about when they're talking about relative asset performance, right? And, Ari, what you were effectively just saying is that we're at the end of some type of super cycle, or you posit that we're at the end of a super cycle. And when the music stops, as it inevitably will, you're not talking about kind of just a small shift. You're talking about a total reorganization of the way that we've designed markets. And that's why there's kind of, I think actually part of why, again, the question was leading from me and why I have such conviction of this moment and the narrative relevance of this moment has to do with the degree to which I'm watching people, the huge number of forces in society making it so laid bare, it's creating this vacuum into which people are trying to figure things out, right? And Bitcoin is one of the few things that actually exists as a credible alternative, right? And I think is particularly appealing to a different type of demographic. You're seeing this all over the place with who you're seeing get involved, and it's you obviously have the Paul Tudor Joneses of the financial world, but you're seeing CoinDesk had its consensus event the other day, and you have Michelle Phan, who's basically invented YouTube influencers and then built huge companies in the beauty space, talking about how the decentralization of beauty and fashion that came from YouTube is now the moment for the decentralization of finance and money is coming, and that's why she's so interested in Bitcoin and is invested in Lolly and these sort of things. And this isn't some fly-by-night random like kind of pop culture thing. There's a much more significant thing happening. So I just think it's the intensity of this moment, I think, is creating more opportunity for kind of people to become open to something different than what we've seen in the past. Have you guys, I guess maybe let's turn that into a question. Have you experienced that with professional contacts, with personal contacts, with the people who, have you gotten those text messages, or have you gotten, return emails from potential LPs that had, kind of left you at the door years ago or whatever, obviously without having to get into any specifics, but, or is it still kind of too in the middle of everything to see that sort of those changes?
Yeah, I'll go ahead and jump in here. It's been surprising, some of the responses that I have seen from people that I didn't expect, honestly. People that aren't necessarily, certainly we see a skew in terms of demographics towards slightly younger demographics. I've seen a lot on the older end of the spectrum kind of reach out in the midst of this. They're not gold bugs. They're not crypto people per se. I think everyone's a crypto person in reality, but they haven't gotten there yet. And if, basically just said, how are we going to pay for these things? Like, where is this money coming from? And surprisingly, a lot of them have seen money printer go burr. And it's odd how much the bumper sticker works here. And so I've been surprised the number of people that have said, hey, can you help me set up like an account on the exchange? And particularly interesting was seeing a couple saying, hey, I'm looking to buy some for my kids. I'm just looking to set it aside. This is not going to be a huge portfolio allocation. I think this is important that I buy some and just set it aside for them. And that kind of caught me by surprise, because we're in this industry all the time. We're talking about it. Certainly I feel that way, but it surprised me when I see people from far outside, not even right on the fringe, kind of come in with those kind of comments.
I will say, as many people know, I came from the family office world. And so I keep very deep connectivity there. And I've said this publicly on Twitter, the Paul Tudor Jones letter reverberated more than anything in the last 3 or 4 years in my existence in this space. They read that letter. Many of them read that letter. They saw him on CNBC. It was a very, very well thought out, disciplined approach to exposure into this asset class, especially Bitcoin. Lorenzo Giorgiani, who is formerly the deputy director of the IMF, obviously co-authored that at Tudor Investment Corp. It was incredibly well thought out and disciplined in its approach. And so that in itself, in terms of hearing from people, hearing from potential LPs, hearing from investors out there, that really kind of resonated more than Bitcoin appreciation and price or anything else that's happening right now. Unfortunately, the way that most institutional asset managers, family offices, and others out there, they look at the cap table. And I talk about that in terms of, a typical direct investment in venture. They look at the cap table and they say, who else is on the cap table? Because they want to know who else is there. They want to know, who they can share ideas with, who they can share diligence with. And so it's the same type of approach that now that Paul Tudor Jones is on the cap table per se, that Rentech, Renaissance Technologies, is on the cap table. Those things are massively important for the overall interest and adoption of Bitcoin and the asset class, more than anything in terms of the price right now.
How much do you think, let's push on that just a little bit though. How much do you think that part of that is coinciding with the resilience narrative from the price rebounding so much? I mean, are you able to actually separate those two out? And this can be for anyone, not just, I mean, David, you're welcome to follow up too, but.
Yeah, I don't think it's the price. You know, as Paul Tudor Jones' letter, you know, kind of examined, the surrounding infrastructure and what is supporting Bitcoin and other digital assets has matured. You know, with the entry of Fidelity as a qualified custodian, of the entry of Coinbase, obviously with their custody programs, the institutionalization of this asset class has been rapidly approaching for the last 2 years. And so no longer can institutional investors say, okay, I get it, I just don't have the bandwidth. It's always been a bandwidth issue. They always like to say, I don't have the bandwidth for this. And that is obviously because it's too dangerous for me. I don't want to have anything associated with career risk right now. Now that that career risk is dissipating, now that they see other institutional investors kind of programmatically getting into this, now that they see the institutionalization and the platforms available to do this, that bandwidth issue is kind of dissipating as well too. And so it's all kind of very lockstep.
I think David nailed it. The only thing I can add is the interest that I saw was really tied to the money printer Gobert and Paul Tudor Jones, and I didn't see a pickup with the price rising. So I think, I don't want to just repeat David's well-articulated point about the career risk thing. David, I had a somewhat similar background. After SIG, I was at an endowment where, I mean, your number one priority is basically avoiding career risk and kind of being responsible and prudent. And let me think what I can add to that. One thing I'll add is that one interest has always been stymied by infrastructure. And whenever I talk with crypto insiders, with kind of like developers, they're always skeptical about this because to them it's not that hard. Or some of them remember a time when running a Bitcoin node meant a command line, you know, and that was the only way you could use Bitcoin, right? People from 2010, 2011, and they're like, what are you talking about? Now your grandmother can use it. And your grandmother might be able to use it because your grandmother is okay using an iPhone app or a desktop wallet, but an institution is not. When you think about the challenges that a family office faces or just any institutional investor, one, it can't be any one individual who can control the keys. They have to have a administrative kind of control hierarchy, where usually it's like at an endowment, it's not like the CIO can just choose to move $2 billion. That goes through a whole series of checks and you know, approvals. We still have a lot of work to do in the industry on security. You know, we talk about like composability and DeFi, but even something we're now making inroads into prime brokerage, which I think is hugely important. But right, think about a family office or pension or hedge fund that, you know, has State Street and Goldman as prime brokers. They can't yet do lending. They can't do borrowing, not in the way they're used to with a prime broker with counterparty risk. A lot of them can't onboard to the exchanges that have the most liquidity. They can't get on BitMEX or Binance, both because those exchanges won't allow them and because they don't trust those exchanges. So what we've seen recently was CME future volume really picking up, and that's actually, I think, very significant because, you know, back CME futures launched, what was it, early 2018, or I actually remember CBOT was late 2017. I forget exactly when CME did theirs, but there was so little volume that a hedge fund that wanted to buy $100 million worth couldn't. They would have been the entire market. They would have been creating an arbitrage that was massive. So the liquidity on regulated instruments like the CME, where you don't have any custodial risk, you're not having to deal with storage or administrative rights, is actually really important and still a major impediment. Even things like accounting software and auditing software are still kind of, or actually, I'll give a concrete example. With most assets, if you're a trading firm or a hedge fund, you can very easily delegate certain authority to a trader. You can say you have the ability, like when I was at SIG, I could trade $100 million worth of crude oil futures. I couldn't walk away with barrels of crude. I couldn't withdraw assets from the company. We didn't really have software that allowed that in crypto until now. There's a couple fairly new products on the market that let a crypto hedge fund have cut those controls in place over a bunch of traders where the traders can't just walk away with the crypto. So we still have a ways to go on infrastructure, but we've made huge progress. The CME future volume picking up is massive. Players like Fidelity getting into the custody game is massive. So, now the more ambitious, those with a little more bandwidth who are willing to put in a bit more time to diligence, now they can get in.
Speaking of players getting in, what did you guys make of the Goldman Sachs piece? Everyone was kind of high off of Paul Tudor Jones, and that was announced a couple days early that they were going to do that presentation. And I remember a lot of tweets being like, "Here it is, number 2, Goldman coming in," and obviously it was the kind of the opposite of that. But what do you make of that?
Spencer, you want to take a stab?
Sure. I don't make a whole lot of it. There's, I think that there are a lot of different takes that you could have on the space. I do not agree with theirs. You could say that it's lazy and misinformed, but that might just be derogatory tax at someone that takes another view. So you know what? Overall, I'm always glad that there's at least somewhat of a balanced discussion, even if I think that sometimes the other side is a little bit misinformed in this case. Honestly, I didn't spend too much time on it. I think there are a lot of positive resources on there. Certainly, people will cite the Goldman research, but Goldman changes their views frequently, and be surprised to see them play both sides of the table on this one.
I was quite disappointed, to say the least. A lot of that research and a lot of those themes were, and Nathaniel, you talk about themes all the time. A lot of those themes were from 2016 and 17. That was what was disappointing to me. They effectively seem to have missed the last 2+ years of institutional build out that I had just alluded to. And the work didn't seem to really be there. And so, if you're going to make claims that there are issues within digital assets, especially Bitcoin, there are structural issues for sure. There are platforms out there that offer massive amounts of leverage that cause disruptions all the time. There are cascading liquidations that happen during March. There are, obviously conversations about needing to have fail safes and having to have, switches on, very similar to we have on the NYSE. There are structural issues in the capital markets that you can obviously make and opine on that are more relative today than they are, versus say 2016 and 17. And I think one of the things that was really disturbing to me and that was really upsetting to me is the inference that Bitcoin is used from ransomware that is also targeting people that are on the front lines that are trying to facilitate with the recovery of COVID. That was very disturbing to me, and I don't think that was appropriate. And it just showed to me that they were having a very negative bias towards it versus having more of an objective bias, on a more of an objective conversation about it. And again, redacting back to the Paul Tudor Jones letter, that call was spurred on specifically by Paul Tudor Jones's letter and his entry into the space. And so they had a few weeks of runway to really kind of figure things out. And it really was disappointing to see that they did not.
Keep in mind that the default, the default, let's keep in mind, is that there's poorly informed criticism of our industry, right? That's been the default for a long time now. So it's more notable when someone comes up and actually has either one, a really well-founded kind of support of it, like Paul Tudor Jones does, or a really well-founded criticism is welcomed as well. But overall, when it's hey, another bank, one unit within another large bank publishes poorly researched information on crypto, ultimately, the good thing here is that crypto is not really susceptible to this kind of poor information, right? Crypto grew out of literally 6 years of this, and continues to do so and continues to gain more attention. So I'm not particularly concerned.
Yeah, the smartest money macro guys have all been in personally for a few years, and I suspect a lot more will announce in the next quarterly letters that they're in Bitcoin. I haven't been privy to the calls, but there've been kind of groups of calls of people like Paul Tudor Jones, like the very, very elite billionaire macro managers who've been talking about this for over a year, and they'll have quarterly calls where they discuss strategy. Those guys are always long ahead of the private client advising. It's a little disappointing in the short term in that if Goldman came out and told other clients to buy Bitcoin, that would certainly be bullish short term, but I don't view it as existentially worrying. There's just a pattern to adoption, right? It's it's not surprising to me that people over 60 generally get into crypto later than people who are under 30. That's just kind of the pattern of any new tech, any new industry. Private client advising is a lot like endowment in the sense that it's much more about protecting your downside, whereas the guys like Paul Tudor Jones are collecting carry on upside. they're paid to take risks. Private client advisors are not. They're paid to avoid, basically, to risk minimize.
So let's shift gears to going back, I guess, to even more kind of macro questions. After a year or a half a year now of the unexpected becoming normalized very quickly, what are, how are you making sense of these markets, of everything happening? I mean, are you guys just sitting and kind of waiting to get more information? Are you acting? Are you allocating? I mean, how do you think about just operating as investors in a time like this?
I love crazy periods. Love them, because during normal times, investing just in general, not even talking about crypto, but certainly it applies to crypto too, it's very competitive. You have a lot of people, taking time to gather data, poring over it, analyzing it carefully, fighting over, in traditional markets, basis points, and crypto, a few percentage points. When things go crazy, I think it's just way, from my perspective at least, it's way easier to outperform. And by outperform, I don't mean that in a direct quantitative sense. I mean it generally in that, you look at traditional markets, in 2007, discretionary traders, like what I was at Susquehanna, were getting eliminated by algorithms. Not all of them, but basically if you were in a liquid market, you were getting replaced by machine learning algos. When you have a regime shift, when you have the nature of the game changes, that freaks a lot of people out. Humans tend to break down, and the algos break down, because they're trying to trade based on a 1 year, 3 year, 5 year data set, right? As an individual, you were able to beat Wall Street in 2008 for a few years, because all of Wall Street was anchoring to 30 years of real estate data. If you just applied a little bit of common sense and said, this actually is different. I can't, yeah, those quants, they might have PhDs, they might have teams of 100 quants pouring over 30 years of data to 8 decimal points. All of that's worthless when you have something that hasn't happened in 30 years. So Black Thursday, those times are incredibly exciting to me, because you get to, it's less about extreme attention to detail and number crunching and do you have every last bit of data, and it's more about applying, it's more about being cool, calm, and collected, and applying common sense. And it's great because you have this little window where you can so clearly be greedy when others are fearful, and vice versa. Normally that takes a decade to play out, and it's often very tough. I'd say that with equities right now, are people greedy or are they fearful? It's not super obvious to me. It's a mix. I'm personally bearish on equities over a 5 year time frame, but it's not like I can say that everyone in the world is super bullish equities or vice versa. Whereas Black Thursday, basically no one, there were obviously people buying that night, but for very clear reasons, people were freaking out, right? Not just because they were fearful of the price, but because markets were breaking, because exchanges were breaking, because you had to worry, if OTC desks that had loans out didn't know if they were going to exist the next morning, they were still going to be solvent. So it's not that people suddenly became idiots. It's that these structural forces that are invisible to a lot of retail traders. If you're an individual trading Bitcoin, you don't necessarily even see this stuff happening. As one other example, I was a treasury bond trader for a while, and treasury bonds are rehypothecated. So a prime broker will lend it out, and the same bond gets lent out and relent out and relent out a dozen times, to the point that no one knows who actually has the bond. And every few months, this has gotten less and less frequent, but every few months, you'll have what's called a failure to deliver, where someone is owed a bond and another prime broker can't give it to them, because there was usually a minor administrative error somewhere down the line. And suddenly you have this whole cascading weird thing happen in the market, where I might have short sold a bond that I need to cover, but I can't get delivery on it to actually meet my contractual commitment. And the way Wall Street deals with that is handshake agreements. Theoretically, that could end up in every Wall Street bank suing one another. It doesn't. Basically, they just say, we'll just kind of shrug it off and basically deal with a few basis points of lending loss. But the point is, that's kind of invisible to everyone else. But if you're a trader, if you're a treasury bond trader, your world is ending when that happens, because you don't know if you're going to be able to meet your contractual commitment to deliver a bond. So to me, those are really exciting times to be an investor and trader. And it's actually, for general retail traders in traditional markets and crypto, that's kind of the only time that I would suggest aggressively betting against the professionals, because the professionals are handcuffed by their normal business. So right, if you have OTC desks that normally have 10 times the information most of us can have, 10 times the liquidity, they have the cheapest cost of leverage, they have the best access to counterparties, they have every advantage. They're going to beat you in trading. But their day-to-day business requires that they take certain types of risk. Counterparty risk, if they're doing arbitrages, they have positions on exchanges like BitMEX and counter positions on Coinbase. And on those nights when the market blows up, those OTC desks are forced to do the exact opposite of what they want to do. They don't have a choice because they're already overexposed. And if you have fresh money, if you have fresh capital, if you're a retail trader who doesn't have a bunch of giant arbitrage trades on, you can go onto Coinbase and buy Bitcoin at 4,000. And so you get this incredible edge. And the same was true in real estate and Wall Street generally in 2008. Same was true, crude oil just traded at negative $37. That actually wasn't easy to exploit as a retail trader, but just it's an example where every Wall Street crude oil trader, not all of them, but plenty of them who were forced to trade crude oil every day, they were buying at $2, at $1, $0, and they're getting margin called and liquidated negative 10. That was actually pretty hard to exploit as a retail trader because the contract was expiring. You couldn't have just bought crude oil negative 10. But the point is, you actually have kind of the luxury of not having to make a market like if you're an options market maker like I used to be, you're legally obligated to constantly make markets. And so what happens is if the market is moving in one direction, you end up with a long position whether you want to or not. Whereas someone with dry powder who isn't trading options every day, they get to step in and do a great trade when you're handcuffed by your day-to-day business.
I just want to dip in. I know we're getting close to, I think we're supposed to start at 5:40. Tell me if that's right, Nathaniel, is that right?
I think so. I think that's, Ben will tell us, I'm sure, in the chat if we screw it up.
I think in terms of ideation, in terms of being able to find pockets, right now, as we alluded to at the top of the hour, we're dealing with a situation in society that has not really presented itself. Not only do we have massive social unrest that harps back to 1968, but we also have been dealing with a global pandemic where we are questioning everything around us. We're questioning if physical, fiat is dangerous to hold in our pockets because it might carry a virus. All those sorts of things are happening, in real time and very, very fast. And I think one of my favorite quotes from Howard Marks, and we talk about Howard Marks a lot at our firm, in order to achieve superior results, an investor must be able with some regularity to find asymmetries, instances where the upside potential exceeds the downside risk. That's what successful investing is all about. And that really just rings true with us. We're, the ability to find those types of opportunities now amidst a global pandemic and massive social unrest are presenting themselves because more people in the public and the population out there are questioning the social paradigms that we've been dealing with for hundreds of years.
The only thing is, about investing in these kind of climates, for us, we operate venture funds and venture funds only. So we're not trading, we're not moving positions in these. When we do see Black Thursday-like events, it does give us an opportunity to deploy capital. It's always scary time. So it's always kind of, watch and see what happens. But, always the idea is that we can call capital counter-cyclically, right? So, when we see big market events, normally what happens is your investors are trying to pull capital from your fund. That means that you're a forced seller at the bottom. Like right when prices are discounted, right when you want to step in and buy, everyone yanks their capital. Really, really painful. And the opposite is true as well. That like markets have exploded. We're in late 2017. They're saying, here, take more capital. Right as you're kind of saying, things are looking a little bit expensive right now, right? Like I'm a little bit nervous. And so, given the liquidity profile, venture funds tend to be very difficult to raise, right? We're asking our investors to lock up their capital for 8 to 10 years. That is a very long commitment for them. But what it does allow us to do is stand there and invest kind of counter-cyclically relative to the market. And so, for us, it's business as usual. We're making a lot of equity investments. I have a term sheet going out later tonight. And otherwise, keeping an eye on several liquid assets as well.
Well, it's been great talking to you guys. A friend of mine, Emerson Spartz, who I think some of you might know, we had this conversation recently about punctuated equilibrium or moments of punctuated equilibrium. These are moments where things that have been bubbling for a while all of a sudden have this massive push forward. And it turns out how evolution works. It's not one straight line. It's very long periods of calm followed by kind of explosive Cambrian explosion type moments. And I think we're living through one. And his assertion is that in those types of moments, it's the only time when you can beat the smartest guys in the room because there are no smartest guys in the room. So I appreciate some of the smartest guys that I know being in this room for now. And it's been great talking to you and excited to see the rest of this event.